The broadcast is now starting. All attendees are in listen-only mode.
Hello, good afternoon, everyone, and welcome. My name is Martin, and on behalf of Leoron, Mr. Mark, and myself, I want to thank you, everyone, for joining us in today's webinar. As you already know, today we'll be discussing about the crucial role CFOs and finance executives have in the current business world. This webinar will cover topics such as broadening CFO beyond strictly financial and accounting frameworks, developing interdisciplinary thinking and ability to communicate with the board members. So in the first part, our expert trainer, Mr. Marc Cannizzo, will be talking about the topics which I mentioned earlier, and then will be Q&A session. So during the presentation, if you have any questions, you can post them in the right corner, and our trainer will try to answer you properly. Once again, thank you very much to everyone for joining, and I hope that this webinar will be informative for all of you. Mark, it's a pleasure having you today. I leave the stage to you now.
Okay. Thank you very much, sir. It's an honor as well to be able to speak to our audience today. This is about the CFO Masterclass, and I'm going to go talk you through a few themes which typify the program that we run in CFO Masterclass. So the agenda today is basically a microcosm, a quick look at some of the key topics which we cover in the CFO Masterclass. So I will spend a limited amount of time on each of these areas, primarily to pose questions, to put questions to you, because I know that you're a financial level audience, which means that there may be CFOs out there, financial directors, other types of financial executives, and so on. And as we know, the ambition will be ultimately to rise to the top level of any organization that we are involved in. I'm assuming, that's an assumption I'm making, that people have the personal professional ambition to be able to rise as high as they can in the organization, which means that the idea behind the CFO Masterclass is to prepare CFOs for taking a company-wide perspective and to go beyond the pure financial and accounting areas, which I have no doubt you are masters of, and that is wonderful. Where it becomes a little bit tricky is when you are involved at senior executive levels and talking to the board and so on, and have to find arguments and to represent positions that will take into account factors which are not strictly financial. And this is where the challenge comes. And I have had people come to me personally for coaching to understand how they can learn how to take on a greater role than just the CFO. Because CFO is very, I won't say narrow, it's very broad, of course, but the financial area is quite vast. And there's a lot of technical stuff to be mastered. And of course, we have other courses and programs which are covering those areas, from budgeting, from business valuation, financial accounting, management accounting, things like this. Okay, so let me just start by, you can see here there's an agenda. I just made for myself a list of some of the salient, i.e. the relevant items which come up in the CFO Masterclass, or which are mentioned. And what I'd like you to do in this next 45 minutes or so while I present is to ask yourself two things. The questions that I pose, are they relevant questions to you? And secondly, do you have answers to those questions? Because the program that we are going to run in just a few days actually gives us more time to treat these topics and to elaborate on them and to hopefully stimulate some discussion as well. We do the best that we can online to be able to get interactivity with our audience. Of course, in the classroom itself and in a workshop setting, the discussions can be very intensive. So we have made a great effort to be able to translate that kind of experience onto the online environment. And it's not always easy, but you know, in a time of COVID, I think we're all faced with different types of challenges. So let's just start with the first topic here, which is mission statement. It's kind of connected to the issue that we have with regard to strategy. So strategy forms an important part of the CFO Masterclass. And of course, our approach is to take a broad view of strategy. Now, I know that many textbooks like to talk about strategy in very complex ways and very technical ways and almost sociological and so on, academic, let's say. And that's good, that's fine. I think the academics should give some deep thought to what strategy means and so on. We're practitioners. We are working in the real world, and we know that strategy is something which is very important, even though people tend to deal with strategy in different ways depending on the kind of organization that they're working in. If you're in a large organized company, then you will have a certain systematic way of approaching strategy. In fact, that's very good. It's formalized, of course, because it's been developed over time. If you're working in your own business, a privately owned company, then strategy will be done in a completely different way. It will be done in a more informal, brainstorming way. Okay. Now, both ways can be perfectly good. We just have to we have to realize what the downsides are to the formulation of strategy and how we do it. Because in a large formalized company, doing strategy may be just checking the boxes and going through a formalized set of bullet points or checklists and so on in order to say, okay, we've done our strategic analysis, here it is. We don't have to think too hard because the forms that we have to fill out, they do the job for us. That's too formalistic, that's too routine, that's too mechanical. You lose the benefit of brainstorming. Brainstorming is fine, but brainstorming shouldn't just be a talking shop. You should want to be able to channel the discussion to look at relevant points and to be able to come to decisions about what action steps to take. So you see, we can learn from both ends of the company spectrum, both from large listed companies to small SME type of companies, privately owned companies, family companies, for example. So I like to think of strategy in a very simple way, plan of action designed to achieve a particular goal. And this is the key thing. Some people think that strategy is the goal. But I like to think of strategy as being a roadmap and a way of achieving a goal, which means you can't do strategy unless you have a goal first. If you don't have a goal, then you're just traveling nowhere in particular without a destination. So we have that kind of discussion. And in my own consulting work, I've had these discussions with business owners before where we developed this process of developing strategy. And of course, strategy can emerge from having a vision and mission for your company. The idea of vision and mission, this is well known again in large formalized companies because they listen to the consultants like me and they say, oh, we must have a vision, we must have a mission statement, and they write one, which sounds good, and that's the end of the story. I have worked with private companies where I suggested, do you have a mission statement? They said, what is a mission statement? Well, do you have a vision? Well, and we talk it through. And they say, well, I think this is only poetry. I had one guy who said this to me. I think this is only poetry. It's really kind of meaningless. I said, well, no. Your stories that you tell me about your customer contacts and what you consider to be important in your company, what you expect from your employees, how you treat the customers, all of that adds up to your values. Why don't you kind of try to formalize that definition of what your value system is in the company so that other people can learn from it and learn to behave according to your codified set of principles. So you see, out of a natural process, you can develop a mission statement, vision, and so on, and then have the basis for being able to look very practically at how strategy is going to be developed. So in the CFO Masterclass, these are the kind of discussions that we develop. And of course, I would invite people in the audience to think about these things and to apply it to your own company. This is the best opportunity you have to diagnose your own organization and to see if you are meeting the basic requirements of mission statements and strategy, and how well you do it, how you could improve it, because it's always a work in process. And of course, this year, talking about strategies and budgeting is always a little bit of a painful exercise, because nobody, I guarantee nobody last year, when they were thinking about 2020 and beyond, thought of the implications of COVID. So, I mean, I almost think that perhaps the thing that comes closest to a strategy with regard to COVID probably would have been, back in January, a disaster recovery plan. Because a disaster recovery plan means when everything sort of flies apart and doesn't work anymore, people think in terms of disaster. Maybe COVID really fits that scenario. So to the extent that some organizations have a disaster recovery plan, maybe that suits for the moment how you've been dealing with COVID. But now we've got to think forward into the future and resume with strategic thinking. Okay, so this is one area we spend enough time, I think, on this area to get the point across that people come away, they take it seriously if they didn't take it so seriously before, or if they took it very, how should we say, very lightly. Now they give more emphasis to this. Now let's look at the next area, DuPont formula. What's DuPont all about? Well, I just wanted to bow in the direction of saying, okay, of course we are financial people, and we manage to some extent by the numbers in the business. So if you think that the mission statements are only poetry, let's move from the poetry to the reality and look at the numbers. Okay, so we talk about the numbers, we talk about financial statement analysis, but of course I'm not here to teach CFOs how to read a balance sheet, that's for sure. What we're trying to do here is to start from the financial statements as our starting point, and to say, okay, what we need to do, of course, is to devise a way by which we most effectively analyze ourselves, diagnose ourselves as a business from the standpoint of the numbers. And I find that DuPont is actually quite a good exercise to run through, because what it does is it's integrative. It's synthesizing a number of well-known financial ratios, but we try to add meaning to them. We don't just teach the definitions of ratios, but we try to push beyond that and to understand the reality behind the numbers, which is why we look at little cases such as Texas Instruments with Hewlett-Packard to generate, based on real live numbers, what their ratios are that fit into the DuPont formula, and to diagnose and pick apart these different ratios to come to some insights into how to use most effectively financial ratios. As you can see, these are two companies which are in the same industry, but the key thing is to differentiate between them. If we look at the bottom line, they both have a return on equity of about 33 to 34%. So you could say, okay, in that respect, the companies are similar, but that's similar in terms of results. If we go upstream to the processes, the operations of the companies, and we work through and try to come to better insights as to what's happening inside the companies to produce these similar ROEs, we come to some surprising results. And that's what we spend some time in the CFO Masterclass to get at, those numbers as well. We don't want to leave numbers aside. We want to treat them in a way which is worthy of your positions in the company, because you're always looking to refine your methods and to push the envelope, so to speak, so that you can get the most out of understanding not only your financials, of course, because you have access to all the internal numbers, but also, of course, to do a competitor analysis and look at your competitors. As you can see here in the DuPont analysis, we've used publicly available information because, of course, we do not have access to the management accounting numbers of the companies involved. So what we're doing is we're using financial accounting ratios that are derived from the financial accounting to generate these ratios, and through the DuPont process to try to understand and analyze what's going on. And you're doing the same thing, of course, with your competitors. And that's another skill which, of course, always can be refined. So the DuPont system ratios, we do a little bit of detective work. We kind of work backwards from the ROE, and we disaggregate the financial ratios in order to try to understand what's happening in the operations and so on. So that's another quite important subject area that we do cover in the CFO Masterclass. Okay, now we move on from financial accounting to the management accounting area, and of course we talk about the distinctions there, and you know very well what those distinctions are. What we try to do is we try to put the management accounting knowledge to use. Here is one example of the results of a management accounting system, and that is the transfer pricing arrangements that companies have. And I'm talking about now complex companies. This would be multi-units that are inside a group. So here I am actually addressing specifically those of you who are working in larger entities that have different separate legal entities, separate P&Ls and so on. And therefore, you've got to manage and conduct a group of companies towards a common end, a common objective or goal. So always think back to the strategy. Always think back to the hierarchy that we have. We set goals for the group as a whole. And if you're in a private owned company, for example, then of course you have a consistency of objectives, because what's good for the company itself is good for obviously the owners and presumably the employees and so on. So there you have a much more simplified situation in some respects. But when you get into a corporate sort of structure with different entities, then we have to start to understand what the implications are of running different P&Ls. And our key concern is going to be one of goal congruence. You can see that here on the slide. The first line here is actually shown as goal congruence. That's one of my favorite words, or terms, I should say, because it's so important and people don't really think very hard about it. And this is one of the drawbacks that we have with regards to running businesses. We kind of set targets and we think that what people do is consistent with the overall objectives of the firm. And when you dig down deeper and you look at the realities of it, you'll find some surprising things actually going on. People thinking that they're doing a very effective job in terms of working towards a common goal. But actually the incentive structure and the way we define goals actually may cause people to be deviating from each other and traveling along various paths. Now, I'm stating the problem here in terms of words, but we put numbers on the story here. We go through exercises with numbers to demonstrate how it's possible that you could have a system of transfer pricing in which two units within a group of companies may be working, in fact, against each other. And we demonstrate this both numerically and draw some policy conclusions from this area. And it's very important that we recognize that in a transfer pricing system, for example, the first question that we need to determine is whether a given transaction should be kept within the group or whether it should be outsourced to a third party. And oftentimes people forget about this. They assume that in a transfer pricing problem, it's what the price should be between two entities, A and B, when they deal with each other. And that's an important element of transfer pricing. And of course, if you're a CFO and you have entities coming to you, you're at the group level, and you have to be the arbiter of certain disputes about pricing between different entities, and you have to make a decision. You want to make sure that your decision rule is going to be a good objective one, which is going to be the best for the company as a whole. You're not tied to maximizing the P&Ls of any of the divisions within your group. You want the company best interests to be served first. That takes priority. So really, the first question in transfer pricing system, actually, when a transaction is given to you, or a situation where Division A and Division B do not have an agreement as to what the price should be, the first question you should be asking yourself is, should the transaction take place in-house, or should it be outsourced? And people often lose sight of that. And that's why transfer pricing system already goes wrong. So we take a very step-by-step approach to this, a rigorous approach to this, to answer the first question first. Do we want the company transfer to take place inside? And if we don't, there should be objective reasons why we outsource it. And then, of course, there are longer-term organizational and structural issues that arise from the consequences of our decisions. But that's what we cover in this particular area when we talk about transfer pricing system. So it's actually potentially a huge area, and I like to give it enough time because sometimes in these stories you've got to go down in the weeds, which means you go down into the details to be able to extract the larger lesson. And I find that even people who are working at the finance director level that have been kind of parachuted into a complex organization, they're kind of firefighting from day to day, and so they're confronted with immediate questions about whether what the pricing should be between two units that are fighting over a transaction. And here we're trying to give you a kind of a space where you can step back and you can get an overall picture and test your existing transfer pricing system, and to see whether it is meeting the basic principles that have to obtain for us to be able to say that we have a rigorous and a good transfer pricing system. Okay, don't assume that the more complex the company is, its systems are perfect. In fact, the opposite can be true. Sometimes companies inherit from past generations the same kind of controls and systems, and they don't update them, they don't evolve them, and they find then that they're operating according to a set of a control panel which corresponds to 20 years ago. Can you imagine? And why is that? Because maybe the CEO has been around for 20 years and hasn't really sanctioned any changes. Maybe a perfectly nice person, but just hasn't been able to keep up with the latest movements. I grew up in Switzerland, so I know what tradition means in terms of big companies. You know, the guys with the gray hair, I'm getting gray hair now, they're the ones who kind of call the shots, but they learned some years ago. So the question is, the young guys come in, they've got maybe more recent degrees in different areas, IT and so on, and they know that things should change, but they have trouble making that case. And I'm here to help make that case, okay? So let's just say the CFO Masterclass, in terms of its overall objective, is to help people to be able to make the case inside their companies to make sure that we are evolving according to the latest and the best practices, okay? So transfer pricing system, let's leave that aside for the moment because we still have a lot to look at. Okay, methods of setting the transfer pricing system, the dual pricing, we define these things. Selling division transfers at marginal cost. We go back into, you know, the distinction between marginal and fixed cost, because those are management accounting categories that we need to get our heads around to make sure that we have a transfer pricing system which is based on rationality and based on actual numbers, not financial accounting historic values that have no relevance going forward, but actual real costs, market-driven costs. That's really the orientation point that we need to have when we talk about a good transfer pricing system. Okay, so big topic. And of course, this leads on very naturally from the previous discussion about transfer pricing. That's divisional performance measurement. Again, our starting point in the CFO Masterclass is to start largely with ratios, things like ROCE, return on capital employed. And we talk about residual income, that's RI, and a little bit about economic value added, EVA. These are all based on management accounting measurements. And what we try to do here is to remind ourselves how it's possible for a corporate structure, a complex group, to actually be following the wrong measurements, the performance measurements, that they might actually be making mistakes or making suboptimal decisions, as we say, by tracking financial accounting measures, like P&L, net income at the divisional level, maybe pre-tax, depends. You can define it in different ways. But what we need to bring to the front here is that if you're running a business and you have divisional performance measurements, you want to make sure that the divisional performance measurements themselves are goal congruent. I come back to the that term I used before, because once you get the idea of goal congruence and the fact that the objectives of the group have to be met first and foremost, and therefore every other level inside the company, division level, department level, individual level, all of those are subordinate to the group interests. And that's why it's important for managers and executives to define goals and the measurements of those goals in a way which is goal congruent. So again, this is a great area, in my experience, where people have been able to diagnose their own businesses and say, okay, are we adhering to the best practices in terms of what should we be measuring inside our company? Are we measuring the most effective ratios, for example? Are we measuring them in the most relevant way to be able to say, yes, we're doing a decent job? Okay, so here we're kind of pushing from financial accounting to management accounting, ultimately to cash-based performance measurements. Okay, cash-based. So that's really the greatest proxy of value in the business, and value creation is cash-based. So we'll be talking about cash flows and all those sorts of things as well, but at a high level. Okay, I don't want to stay at the junior level or at the beginner level. So before anybody considers taking the CFO Masterclass, you might want to just make sure that you're, you understand the basic ratios that are involved, financial ratios and so on, because I use those as a starting point to push in this direction. Divisional performance measurement is really important because we need to understand, for example, the advantages and disadvantages of things like return on capital employed. Now, we define, of course, capital employed. What I like to do, and I actually do this in all my programs, is take a high-level view of capital employed. I take a typical balance sheet and I kind of look at it from a extremely simplified point of view, because sometimes extracting simple ways of looking at things is sometimes the most effective way. Keeping, it's a bird's eye view. It's keeping a focus on the big picture, because that's what we need to do at the end of the day. We understand that, of course, investors are looking at our accounts and they want to say, okay, what is your return on equity, for example, but we need to operate within the company and back up a little bit to talk about, well, how well are we doing on our capital employed, which is, debt plus equity. How well are we doing based on that measurement? And then what is the resulting impact on return on equity? You can see here that the transition between ROCE and ROE turns on the amount of financial leverage that we have in the business. In other words, our capital structure. So we talk about capital structure. Of course, we can't not talk about capital structure when we're discussing between finance professionals. But again, I like to do it in a way which achieves two things. One, it allows you to be able to reset your focus to make sure that your company is measuring the right things most effectively in terms of your own daily job. And secondly, to give you some hints on how to explain this stuff to the non-finance people, because I find that oftentimes this is one of the hurdles involved. We can help deepen the professional competence of the finance professionals. That's what we're all about, actually, as in the financial division of Leoron. Yeah, but one of the things that that gets forgotten a little bit is, well, hang on a second, but you, the audience, you also have to go out there and you have to make sure that you get non-financial people on board. So how do you explain things to be able to enlist, to win over their support, okay? Because that's very important, right? Because if we come back to strategy, for example, you have a financial strategy, sure. Thus, financial strategy is subordinate to the overall group strategy. That group strategy, you have some input into that group strategy. So you need to be able to talk up at that level. And then, of course, you have to be able to come back down from the group strategy to the resulting HR strategy, marketing strategy, production strategy, all those other strategies that are in different parts of the company. Those are your peers, basically, people who are operating, to your left, to your right. They're sort of at the same level as you are in the company hierarchy, but they're dealing with fundamentally operational and non-financial areas. But what they do has a huge impact on the financial results of the company, which is why I like to think that the financial people are really at the heart of the whole enterprise, because you need to think for the others as well as thinking for yourself, and you need to convey to them what it is that you're principally concerned with. We can't all work in our own narrow specialties for a year, not talk to each other, come up out of our holes at the end of the year and expect that we have a goal congruence. Doesn't work that way. I know it. I've worked in big companies. I've worked in small companies and partnerships as well. Partnerships is something else, of course, that's very individual driven, but it all comes down to people. Okay, so we talk about residual income and so on. So that's just another area of concern. Okay, now we also take advantage of the experienced, the mature audiences that we have for the CFO Masterclass, because it gives us a chance to revisit valuation methodologies as well. And this is actually quite a good and interesting area, because it's kind of a good reminder for people to think about, okay, what are we actually doing when we, what is the value of doing a valuation of our company? Probably a lot of people haven't done a rigorous valuation of their company. They might say, well, there was no need to, because our company isn't available to be bought by somebody else, and so on. Well, it doesn't. Valuation takes place, of course, as a necessary part of M&A activity, mergers and acquisitions. And there are a lot of people, investment banks and consulting companies and so on, that knock on your door and they want to do a valuation for you, particularly if they understand that you're involved in some kind of M&A transaction. Our approach is that M&A is just one area of valuation methodology. Valuations can be done from time to time, even if you have no transactions in mind. In other words, there should be an internal process by which you can measure internally the value of your own company. Now, if you're listed, of course, you look at the price of your shares on the stock exchange, and that's great and that's wonderful. And it's important, of course, because you want to make sure that people are valuing you fairly, but there's a big difference, or can be a big difference, between the price and value. And we try to get at that distinction. Because, you know, people like Warren Buffett and so on, they look at fundamental values of companies. And based on that, they determine whether or not a share price of a listed stock is fundamentally over or undervalued. And that's how they go for companies that they think that are trading below their proper value. Okay, so when you have a gap between price and value, then you have, of course, an opportunity there, because smart investors can come in and buy the company and so on, or make an offer for buying the shares of the company. So we're aware of that, because we're working in the real world and we're practitioners and so on. But we also bridge that gap to the theory as well, because the theory has to be rigorous. You need to be good on the theory, and you have to have 1 foot in the academics and 1 foot in the real world. That's basically the bottom line here. So we go through this stuff, but of course we focus really on the cash-based, sort of relevant cash flow-based methodologies for valuation. We do discounted cash flows. We summarize sort of the approach by which a CFO would want to think about the value of the company. More recently, we've introduced elements of options theory into company valuation, which is still a little bit kind of, I wouldn't say controversial, but not everybody has completely adopted it. But we make the case that here's some things that you should be thinking about in order to understand what the true potential value of your company is. So we spend, I would say, a fair amount of time, but enough time in the CFO Masterclass on this issue of company valuation, because I think valuation is something which is always kind of evolving, and we feel that if you want to treat it as a refresher, because you've already been involved in valuation issues, that's wonderful, and you should be involved anyway to maybe update, to refresh, and to think about your approach to doing valuations. So again, an important area. Again, it's based on, you know, basically the financial accounting transitioning into the management accounting, transitioning into cash-based measures of value. And we're bringing into the picture as well a little bit of options theory to be able to broaden one's thinking about valuation. So again, I've just scratched the surface here in terms of talking about valuation. This is a nice sort of diagram here, which shows how we like to trace cash flows to their source. And the source would be the operating value or enterprise value of a business. If you think about this as being kind of like a stylized balance sheet, we're talking about the asset side of the balance sheet. In other words, practically all of the action happens on the asset side of the balance sheet. And as financial people, we're mostly concerned with the liability side of the balance sheet, which is the capital structure, debt, equity, stuff like that. Now you might say, well, geez, you know, where does that leave us? Well, we have a fairly important role in the company when we talk about, you know, dealing with the liability side of the balance sheet. Actually, we can be guided by the German language. As I said, I grew up in Switzerland, in the German-speaking part. In German, the asset side of the balance sheet is actually referred to as the aktiv. In other words, the active side of the balance sheet. Now, when you think about it, that's really interesting, isn't it? Because active, I like to think of the asset side as being the operational side of the balance sheet. That's where the actual visible, tangible activities of a company occur, right? And we're making capital expenditures and we're adding to the capital employed, and that all finds its place, in the working capital and the non-current assets and so on the asset side of the balance sheet. In German, the liability side of the balance sheet is referred to as the passive side. Passive, it almost sounds like, the side that goes to sleep, you don't kind of, you wake up once a year to put the financial statements together to say, oh, we've got some, bonds that have to be repaid. We have to pay the interest. Maybe we sleep on a quarterly basis and wake up. Well, I push back against that characterization of the liability side. It really isn't passive at all, and that's why we're here to interact and to understand the many ways in which we can make the passive, the liability side of the balance sheet come alive, because there's so much going on over there in terms of where we source our capital for the business from the debt and equity markets. And so we spend a little bit of time talking about that. Now, that's not central to the CFO Masterclass, because that's really the core activity, which I expect you are already performing. But we say a little bit about, the cost of capital and stuff like that. We spend a bit of time just to brush up on the basics of the capital structure theory, capital asset pricing model, things like that, just to bring ourselves up to date. But fundamentally, as I said, we talk about these things because they are relevant to the overall goals of the company. We want to understand what we do principally on the liability side of the balance sheet, how that contributes to the success of the asset side of the balance sheet. Okay. And finally, we come to corporate governance. Now, we don't have a separate section to talk about, this is what the combined code in Britain looks like in corporate governance in the US, and do a comparative, institutional comparative analysis of corporate governance. That's not really what we do. I like to link back corporate governance to what strategy was all about at the beginning, where we talked about ways of thinking about the company and how it achieves its objectives and so on. And there is a thread of corporate governance which runs through all of those things. So we're sticking to the idea of corporate governance as serving the requirements of the company taken as a whole. Now, what do I mean by this? Okay, we look at what the key features are of good corporate governance, but principally, I like to think about corporate governance as being about what we do for stakeholders and how we take stakeholders into account. Now, from a CFO's point of view, this is a pretty important area, and one which may be outside your comfort zone. Because when you worry about the best interests of the shareholders and maximizing shareholder value and all those sorts of things, that's great and that's fine, and you got to do that. But the most progressive or enlightened companies have gone beyond just a narrow focus on shareholders, and they look at the requirements of all stakeholders, which means that here's the opportunity for the CFO to step outside the confines, the financial confines of their role, and to think again at the CEO level, the board level, the sorts of things that the board should be looking at that affects the company as a whole. And that's why I like to come around, from strategy discussion, having gone through a lot of nitty-gritty technical issues and so on, but coming back finally to issues of corporate governance and what you should be aware of as a CFO in terms of what to think about. And we have some case studies and things that address these issues from a stakeholder point of view. So this is what you have here is the Mendelo Matrix. In fact, this reminds me that when back in the strategy at the beginning of the course, we go through a number of models which are connected to strategic formulation. A number of I would call them business school type models. They're the kinds of models that if you engage a consultant, for example, a strategy consultant, these are the kind of models that they would bring to you. And what they like to do is kind of razzle-dazzle you with all these cool, fancy models and hopefully to get you to, you know, sign consulting contracts and say, oh, we've got this wizard on board and they're going to, they're going to sprinkle magic dust on our company to make it more effective or more valuable and so on. Well, it isn't really like that. You know, some of the best consultants in the world have actually consulted companies that ultimately have failed. And I'm not going to mention any names, but no, I won't mention any names. I'm tempted to. Okay, I'll mention names maybe, but only in the CFO Masterclass because you have to pay for the privilege of hearing about that. Okay, that's I can't reveal everything up front, can I? So if you don't have an MBA, for example, or if you're kind of a little bit out of the loop in terms of all these fancy models, what we like to do in our programs is to present the models and explain what they do, to demystify them. Because again, that's going to help you to be able to rise above your immediate job description and to be able to interact with investment bankers and management consultants and to be able to talk to them on an even basis. Not that they mention some model, you know, well, of course, this model and so on, or approach or framework, and they assume you know about it. And if you don't know about it, they'll kind of read that and they'll sort of say, aha, this person is at a disadvantage now, this client, because I can teach them something. I know more than they know. And this is where it starts. And we want to kind of help you to even the playing field so that you can sort of say, oh, Mendelo, yeah, sure, we do a stakeholder analysis. We don't call it Mendelo, and this is how we approach the story. So you've kind of thought about these things and you're in a stronger position to be able to get more value out of your consultants because they should be working for you. That's how it should work. It doesn't always work that way sometimes. Benefits of transparency. Again, the more transparent your business is, the more valuable it's going to be in the eyes of people who would want to invest in you. And this has been shown in terms of valuations of oil and gas companies between the Moscow and the New York stock exchanges. In other words, there's a price to the company in terms of valuation if they are not perceived to be completely transparent or adequately transparent, you know, to give enough disclosures to win the confidence of their investors. Now, this works at the company level, but it also works at the stock market level. So if the stock market governance, let's say, in Russia, is not really up to a par as you would expect it to be in London and in New York, then as a system, the Moscow Stock Exchange will suffer a discount on the valuations of the companies that are listed there. So again, there's only so much that you can do as a company if you have a company which values transparency, but you're listed on a stock exchange which may be perceived as being kind of weak in terms of its governance controls, which is why companies like to cross borders and to list their shares on other stock exchanges, you know, to get American depository receipts issued in New York, for example. This may be one of the ambitions that you have as a business. So it's something that you want to think about. So again, we talk about these things and we put the questions out. Again, I hope you are asking yourself these questions and then deciding whether or not you would be interested to participate in a more a deeper discussion of these issues, in the CFO Masterclass itself. And finally, just to come back, I want to summarize. Well, I'm going to conclude now. So just give me a couple more minutes here to come back to the where we started from, strategy as a gap. Okay, so you've got kind of a step-by-step approach to achieve strategy. We said starting with mission and value statements and vision and all that sort of stuff. Okay, I don't take it so lightly. I'm just kind of skipping through it rather quickly here. This is where I'd like to close today with the balanced scorecard. Now, some of you may have heard of it. Some of you may not have. I've worked with the balanced scorecard, and there's a two-step evolution in terms of the balanced scorecard, which I want to share with you today. And this is kind of important because first step is when people get to the balanced scorecard, what the balanced scorecard involves is to look at, as you can see here at the bottom, strategic outcomes with regard to shareholders and customer orientation processes and workforce. And we kind of ask the typical questions. What do shareholders expect of us? That would be this one over here, and this would be largely coming back to the story of return on equity and all the financial stuff. So you might say, okay, this is kind of the domain of the CFO in the balanced scorecard. And then we come over here to what do customers expect of us? And now we're talking about kind of a marketing orientation and how well we serve the customers. So now we're talking more operationally. We're not talking primarily about financial issues. We're talking about operational issues, which hopefully will result in good financial outcomes. The questions here with processes, are our internal processes really up to speed, and are they as good as they should be? So it's an internal diagnostic that we have to ask ourselves in order to make sure that we're doing things. We may have a benchmarking exercise with other companies in our industry to see if we're doing as well as we should be. Okay, so that's another important perspective. Remember, the balanced scorecard has 4 perspectives. You get the financial, you've got the customer, you've got the processes, and then of course here, workforce, how motivated the workforce is, and are we kind of developing our people in terms of internal training and development and that sort of things, that people like the workforce and are motivated and incentivized and so on. So it's kind of more touchy-feely HR type of stuff. You could say that HR is kind of involved over here. Okay, now here's where the problem occurs. People come away thinking that we've got like 4 different areas that we have to pay attention to. And again, this is interdisciplinary, clearly. And they look like they're kind of separate but equal areas that, the people who are concerned about customers do the best job here, the learning and growth here, the internal processes, and of course the financial. And they leave it at that, and they sort of say, okay, we have to make sure that we're good in all these areas. Wonderful, that's great. However, at the end of the day, you have to have an integration of these processes. Why? Because the problem is these 4 areas are considered to be separate but equal to each other, and they are not actually equal. I'll tell you why. And here's a secret, and this is specifically for you as a financial audience. At the end of the day, what you do here and what you do here and what you do here, even if it looks wonderful and feels wonderful and meets the performance criteria corresponding to those areas, if they do not result in added value to the company as a whole, i.e. meeting a financial criteria at the end of the day, they are worthless. I give examples of that. Think about Rolls-Royce, for example. They had engineers who were always tinkering on making the engines more perfect and more perfect, but they weren't actually translating that into additional value. They were spending a lot of resources, but they weren't recovering those resources through a higher price, differentiated pricing, things like that. So it was actually lost effort. So what I'd like to say to you is, at the end of the day, balanced scorecard, financial still comes out on top, because that's the measure at the end of the day, whether we are actually winning or not. And I'm not talking about financial in terms of short-term profit increases, financial accounting quarter to quarter. I'm talking about long-term value added to the business. That's what I'm talking about. So that's where we're going with these kinds of discussions here. So you be the judge whether this discussion has value for you. That's where I want to leave things at this point. I've gone a little bit over, but if I can hand things back to our dear organizer, I think we may have some questions and answers to deal with. No?
Hello, Mark. Thank you very much. It was really great presentation. There aren't any questions. Probably you explained everything in a good way.
I am shocked. I am totally shocked. Actually, possibly, people are thinking already now at the at these questions, because I formulated the questions to be challenges basically, and you know, there's two steps. First, you have to be convinced that the question is a relevant one, and then secondly, do you have some answers to those questions? And that's a two-step approach that you need to go through now, and then be in touch with Martin if you feel that you'll benefit from the CFO Masterclass, which goes through these issues in a greater depth. Can you check again, Martin? Are you sure there are no questions around? Let's give people a few minutes. We have some time.
Yeah, there is no any question. I'm double checking, but there is no. Once again, thank you very much for the presentation, Mark. It was a pleasure listening to you. If you have any additional questions, you can feel free and approach me at any time. Also, thank you very much to everyone for joining us in today's webinar. We're gonna wait a few more minutes. Maybe somebody will have any question, but
Martin?
yes?
I'm putting my email address on the screen if you can read it. Marc Cannizzo, 2 C's, 2 N's, 2 Z's at gmail.com. Yeah, I just want to invite people to feel free to even write to me directly if you, or to Martin, he'll pass it on to me, if you have any questions.
Yeah, there is a question. Can we get the presentation PowerPoint by email? So once the recorded video is ready, we'll share with every one of you.
Okay.
Okay, probably that's it for today. Thank you very much and wish you an amazing day ahead.
I wish everybody
Thank you.
Thank you.
Take care.
Bye-bye.
Bye-bye.